Hello, everyone. Hopefully everyone's doing well. Hello to all my friends. Lots to discuss. Several deals, several proposals. You can comment in the comments, so just doing live, and we can kind of follow that format and talk a little bit about Vermilion. Let me know if you have any questions or any topics you want to discuss. But we're gonna talk about the Vermilion deal. Maybe talk a little bit about Strathcona, a little bit about MEG. So lots going on. Okay, I'm gonna minimize myself and kind of quickly provide an overview of Vermilion at glance. So they're historically kind of very intriguing, kind of controversial name a little bit for many. Um, so currently the trading, so today, when I'm looking at kind of price action today, Vermilion did, I guess on the news, they were kind of the worst performer, I guess, from the names I follow, and I guess it has something to do with the deal. Um, uh, the volume was pretty normal for kind of the typical volume that they experience, so about million shares traded. And here I see that their current market cap is 1.3 billion and share price 877. And based on their slide deck, they show as of May 9th, which was a couple of weeks ago, they show that the price was 894 and 641 on New York Stock Exchange. And the enterprise value was 1.4. So not too far away from where they basically finished today, which is 1.35 billion. But I think the biggest thing about this name was kind of, if you look at the numbers here, right? So they have this quarterly dividend of 13 cents. But market cap is 1.4 billion, so 1.35 right now, and enterprise value 3.5 billion, right? So that's a little bit kind of on the levered side, I would guess, when it comes to debt levels. So they were like at 2.1 billion, and it seems like they had to do something. It seems like they had to make a move, which is what they announced today. So they made a move, and they divested some Saskatchewan and Manitoba assets at about 0.4 billion or so, 0.45 billion. So that's kind of the move they said. So they're gonna get 415 million in cash in the transaction. As I said, they entered the definitive agreement, Saskatchewan, Manitoba assets, and they basically say that the current production on those assets, which my understanding it used to be much higher, is about 10,500 BOEs per day, so barrel of oil equivalent, not barrels, BBLs, BOEs. And out of that cut, 86% is oil and liquids. So almost BBL, so almost oil, but 86% oil and some gas there. And so they're forecasting to generate approximately 110 million in annual net operating income at current strip commodity prices. And the asset approved developed producing reserves of 30 million BOEs. It's evaluated by McDaniel and Associates at December 31st, 2024, and approximately 250 million of undiscounted future abandonment liabilities. So there are a significant amount of liabilities there. And 10,500 BOEs per day. My understanding it was much higher, but the goal right now, as you can see in basically the slide to better understand the company, the goal is to reduce the debt, right? So we're 2.1 net debt. So they basically said, hey, we want to reduce that, which if you look at these numbers makes total sense, right? Like enterprise value 3.5, market cap 1.3, 1.4. There is a lot of net kind of debt aspect to it. So net debt to funds flow operating ratio is 1.7. So something had to happen. Now, what's really intriguing about this transaction too is that, and we can look historically and kind of see what took place and for how they bought it for. So my understanding, they bought it for much higher, but reality is they cash flowed this entire time, that asset, right? So gotta give something to that. But reality is the guiding production on 125,000 to 130,000 BOEs per day. And I guess the 10,500 falls within the standard deviation for that number. So I guess the idea there is that the investors kind of won't feel much decline on the overall kind of portfolio production. And Vermilion is one of those kind of unique companies that are fairly diversified, right? They have operations in Canada, they have operations in Europe. Many may recall the TTF kind of saga from a couple of years ago, where many were speculating that everybody's going to freeze in Europe all of a sudden, and that was kind of the play for TTF and Australia, right? So between all those kind of geographic assets, you have basically that partitioning. So today they divested from the Manitoba and Saskatchewan assets. There is still position in the Matni as well, right? So fairly significant position there. And assuming mid Q3/4 2025 close, they expect full year of 2025 production to be 120 to 125,000. So like I said, it kind of falls within the standard deviation for what they guided before. And with capital expenditures in the range of 680 to $710 million, reflecting a reduction of about 50 million from the divested assets. So that's kind of the net impact on the capex they're going to be spending this year. And they're saying also they're going to evaluate capital investments levels during this period of increased volatility and will adjust capital if necessary to prioritize free cash flow over production growth in 2025, 2026. And so this is something, we don't have to speculate much anymore. The company is basically, many of those companies been telling us kind of similar messaging that they continue evaluating investments, and during this period of a very increased volatility, which is true, very, very volatile period, they're adjusting capital if necessary to prioritize free cash flow over production growth. So in this case, kind of limited production growth based on previous guidance. All right. Well, I don't know how many people even watching me or listening to this. So this was kind of a quick overview of the Vermilion deal, I guess. Maybe I'm just talking to myself and nobody can actually hear me. I don't know. Yeah, if you guys don't mind, just write me in the comments kind of on the stream if any thoughts you have on the Vermilion deal would highly be appreciated. Maybe something we need to discuss a little bit further. But if we look at the kind of slides here for the company, right? I mean, 120 to 125 now guidance. Before it was 125 on the lower end. Capital expenditures obviously been adjusted from this number you can see here, 730 to 760. So they're going down to 680 to 710, reducing roughly $50 million in the transaction because of the transaction. And that 415 million going straight to the balance sheet to reduce debt, I guess. And current strip commodity pricing operating plans would expect to exit 2025 with debt of 1.5 billion and trailing net debt FFO ratio 1.4 times. And in the slide, you can see it's 1.7 times. And long-term debt 1.9. So they're thinking 1.5 minus 0.4 billion. So 415 that they're receiving now. And the numbers add up. So that's kind of Vermilion story. Now, the market didn't receive it that well, right? Like the market kind of saw something kind of finicky about this deal. I don't know the reason why they didn't like the deal. Maybe they expected higher prices. But from the names I monitor here, from about 50 names in the Canadian oil and gas sector, this was kind of one of the worst performing ones. It wasn't by far, it was only minus 1%. Other names that were negative were Greenfire, Ovintiv, CNQ were in red as well, Imperial. Most of the names were pretty flat today. Most of them were pretty flat. The names that did really well today were Ensign, Advantage, Pinecliff, Whitecap, Southbow. despite a very interesting day, because the day kind of started in a very finicky way, right? With Trump tariff kind of, again, some kind of threats there on the EU 50% tariffs. I mean, that's the world we have to, I guess, get used to. But it is what it is. So, and then there was, I think the Dow was selling off initially there, and the market dropped about 1%. So kind of an interesting day, but at the same time, many of the Canadian oil and gas names were up even before oil was up. Um, and another piece of news that was going on today all day was that this whole OPEC saga when it comes to increasing production in I think in July. But despite that, the names held pretty well. Headwater was up 1%. Cardinal was up 1.5%. Right, kind of the oily names. Services did well. Precision was up 2%. White Cup did close to 3%. So names did pretty well. The higher volume names today were South Bow had really high volume, and Varen. Well, no, Varen. I'm lying. It's not Varen anymore. I need to remove that name, which is kind of funny, right? Removing Varen, it's kind of like you're realizing that's it. It's the end of an era. Varen is gone to White Cup. So, all right, let's see what else we can learn about Vermilion. So obviously they have this big kind of geographic distribution. I guess it maybe didn't work in their favor. Historically, people thought maybe it would. Um, yeah, so global gas producer, 30 years operating Europe, North America, diversified portfolio delivers outsized free cash flow. Well, I don't know. It's been kind of one of those challenges, right? Where people expected outsized free cash flow, but it's been challenging last couple of years. Robust asset base combining low decline conventional assets, long life growth assets in deep basin Montney in Germany, out of all places. Strong focus on ESG and sustainable performance, financial discipline, and focused. Here they talk a little bit about key updates. Deep Basin, right? So Deep Basin. So they have this Westbrick acquisition they've done that added 50,000 BOEs per day. In Montney, the CAD cost reduced. And in Germany, right? Not very familiar with that asset, but seems like there is a significant discovery there and some kind of exploration work going on. So they're fourth largest Alberta deep basin producer, 15 years of inventory. Montney infrastructure expansion nearly complete. Inventory to grow production to 28,000 BOEs per day, maintained for 15 years. I really like those slides from Vermilion because they provide kind of an overview, like who is where, and I'll show you one of my favorite slides with Vermilion. This is not it, but I'll show you. This is kind of cool concept from, maybe I'll remove this to make it a little bit more viewable. Deep basin economics, I guess, for them. You can see, and I think it kind of represents what everybody else doing. I guess this is purely for educational purposes. Please look at the disclaimer that I shared before. It looks like this. This is my disclaimer. Here, I'll remove it. Okay, I'll remove myself. But yeah, like pretty good economics, very deep, right? Lateral length. What is that? 2,800 meters. Upper Cretaceous, right? Spirit River, Lower Manville. Many of this applicable for many companies that operate in the Montney. But you can see some of the economics, the IRRs, to why they actually drill, right? And the payouts. Payouts here are like 1.3 years, 1.4 years. And that will be on the, I guess, on the initial cost, right? So some of those wells could cost as high as $9 million, right? But you can see on the NPV10, they close highly in positives based on those assumptions, I guess. Here, I'll show you one of my more favorite slides here. So what this is, no, I think it's this one. So what this is basically, so there's essentially like very little oil in BC, in British Columbia, and you can see how the Vermilion asset kind of sits on the border, right on the border, and so this is not the asset that they divested. This is kind of in the Montney, right? So The asset they invested is Saskatchewan, Manitoba assets there. But here they're basically showcasing where everybody's located, right? And I think it's like super cool to see the map. I've seen those maps before from other people from other companies that presented. But here, what's really unique about this is that you can see the partitioning, and it's almost like as you go to BC, it becomes extremely gassy, right? And if you stay in Alberta, it's extremely oleic. That's why BC production, oil production, barely exists. Relatively to Alberta's oil production is very little. But you can kind of see that, and I think it's common knowledge that they have this ownership of 22% in CEI. I remember Jenny posting a lot about that, but I haven't revisited that name in a very, very long time. But you can see, like on the hydrocarbons, when it comes to oil and gas, it's really partitioning, right? So the way we talk about, let's say, natural gas, well, natural gas is the lowest oil molecule, I guess, that is in our conditions, in atmospheric conditions, is in vapor phase. So it's just humans were kind of invented the easier way to describe things. For example, natural gas, right? Well, how come there is no such thing as a natural oil, right? But humans did not come up with that concept. From natural gas perspective, over 90% of it is basically C1, which is methane. So if you invest in natural gas, you essentially invest in methane production, and there is a little bit ethane there, C2, C1, C2, and that will be kind of in the left corner, left bottom corner, I guess, on the slide, where you have drier gas, right? So it will be more reddish, and you can see what companies are located in that area, and that will include ARC, and ARC will have some sections where it's more, I guess, oleic, so those will be the condensates. Birchcliff, clearly, like Birchcliff, as you can see here, kind of going from oleic zone into the wet gas, kind of dry gas zone. Their main production currently in Birchcliff is gas, right? They're like over 80% gas, I think. And you have obviously tourmaline different pockets. So I think this is a pretty good slide, because this slide, even if it's not very useful maybe for Vermilion investors or people that don't invest in Vermilion, I think it kind of like a puzzle that allows you to think about, hey, who may take what. Personally, I find what's intriguing from this slide is the arc position, right? Arc position, I find intriguing the position of Novista in colors, like where Novista is located, which is kind of interesting to me personally. But I'm sure each and every one of you can kind of see this, I guess, the different names and where they're located and potential future synergies, transactions, right? Often investors, they maybe see an announcement and they caught by surprise. They will see, hey, we have those synergies and we have facilities and we have maybe sites that the companies are sharing. But this map is really good in describing who is where. What you would notice also on this map is that tourmaline, right, is kind of that light bluish color. Tourmaline on the map on the left has this like significant acreage across the Montney, going from West BC towards kind of east, southeast Alberta, and kind of driving that kind of a lot of gas, obviously, from the BC side going into that Kakwa area, I guess, kind of tilting towards Alberta there, which is pretty cool to see. The pink color, Advantage, more on the Alberta side, I guess, and ARC, obviously located in very strategic wet gas, kind of like oleic zones, but obviously a lot of natural gas production. And that oleic phase is the lighter oils phase. It's not bitumen. It's not like hard like C8 plus, C10 plus. Those will be like C5, C6. So those will be like the hexanes, pentanes. Now, those are being counted as oil, but again, humans provide definitions for those things, right? Like at which point you decide what's gas, what's oil. For example, if you go to a Costco and you stop at the gas station, you're going to pick up propane, but propane in the bullet is in liquid phase. So one could say, well, it's propane oil, right? But it will be weird if I was to say it that way, because propane is kind of gassy, right? And we use it as gas when we barbecue. So the terminology, I guess, could be simplified when we say the hydrocarbon chain numbers like C1, C2, C3. C3 will be propane, C4 will be butane. And so the oleic phases here, for example, for a company like ARC, that will be hexane, pentane, mainly kind of condensate, right? And it has very unique application for especially for the oil sands because the oil is too viscous to flow in pipelines. So what would happen there? There will be about a third. I think it's about a third. Depends on the weather and kind of vapor pressure conditions. But companies will take this product hexane, pentane, and will mix it with bitumen, and then because it's soluble in oleic phase of bitumen, that hydrocarbon number is being diluted and oil can flow easily in the pipeline. So that becomes a very necessary product. And you can see kind of in the pockets there, like where the oleic locations are located. But it's very clear tourmaline is kind of like all over that map, right? You do have very concentrated positions, right? You have concentrated positions, I guess, for companies like Spartan. You will see some pockets there. Um, CNRL kind of also spread a little bit all over the place. Obviously, a huge producer. Birchcliff will be somewhat regional where they're located. You can see some pockets of Varen there, right? Now it's going to be Whitecap. And kind of the synergies between Whitecap and Varen, which is now one company. Um, Obviously, Cenovus is located as well in the Montney. You have Bonterra, Archer, Arc, Advantage, and obviously Vermilion, which is what we're talking about here that made this transaction today, right? Basically selling their Saskatchewan and Manitoba assets, getting 415 million, and really kind of placing that money towards this chart where you can clearly see why they did what they did. I mean, there is very little argument about the need to do something here. And I know the legacy asset was sold for a little bit more, but then we have to account the cash flow that was generated during the time frame, which was challenging also because it was kind of like going into COVID and many other things happened in the process. Well, nevertheless, this year they end up kind of forward looking. The past is the past. Net debt is 2.1 billion, market cap is 1.4, enterprise value 3.5, net debt to FFO ratio is 1.7. So you got to do something. So they did something, which is divesting those assets, which is kind of cool in a way because the production is within the standard deviation. So 10,500 barrels a day. You can see outside of that 125, 130 within that variance. And so the new guidance is, I think, 120 to 125,000 BOEs per day. So that's what's up, guys. That's what's happening. I love this map. You can see kind of in the Montney, you have Belly River, Cardium, Viking, right? For many people, it's kind of like um, all these like investment bankers, right? They use all these terminologies and maybe some you will hear from geologists, but you can see kind of the different layers. It's almost like a Costco cake, right? You go, there is a layer of cream, layer of chocolate, layer, and each layer provides different kind of value proposition. It has unique kind of geology there that was realized over millions and millions of years, and there are various hydrocarbons at different levels. And so you can see they can land various wells at different elevations and produce different type of hydrocarbon soup mixtures, right? Like some can use only like gaseous zones if gas migrated to certain zones, and some can produce maybe more kind of oleic partitioning zones. But in overall, this overall region, that upper kind of Cretaceous, Spirit River, right, the Manville, kind of the Jurassics, kind of above the Jurassic, those areas mainly, they're very light oils, gassy oils, kind of dinosaur farts, if you will. Yeah, so I really love that map. I think it's pretty cool. Let's see if people have any comments here so we can talk about stuff. Live viewer comments show up on stream here. This is an example. Okay, I didn't see any comments. Do you guys have any comments? Anything you guys want to share? We have 600 viewers. Let's see. Let's see. No? No, maybe there's one. No, not even one. All right. Oh, 611 views and not even one comment. Maybe you guys don't hear me. Maybe you guys can just see me and just talking to myself. I don't know. Okay, so this is kind of the um, a little bit more here, I guess, from Vermilion on the Montney well economics. So you can see the upper Montney, middle Montney, and lower Montney lateral length, which is like 3 kilometers, huge, right? DCAT cost for per well is about 9 million. So you better get this right when you drill those wells. And liquid percent of reserves 38, IRR is 85, payout 1.2 years, NPV 10, 9.6. And again, those those type curves very important, right? When they drill for those wells, because that initial kind of gushing liquid phase or gas phase is really important for the economics, because if you don't get the type curve properly, then your payout time could be maybe 1.3, 1.4 years, and then you go into environment maybe low prices, but now you already drilled the wells, you already spent the capex. And I think this is not just unique to Canada. This type of designs, not exactly, but the Permian is using kind of similar concept, right? Where you drill very kind of deep, long wells, and you frog them, and upfront cost is significant. So that's why you saw today, I think it was like 6 rigs dropped today, 8 rigs, something like that. So we saw significant drops on the rigs because people looking in this price environment, they're like, well, I don't want to commit capital upfront, because if the experts are right and we are going to 50 and 40, I'm not breaking even. My payout, my assumptions are totally wrong. This is not going to be right. So, and remember, this is not a business necessarily of chasing returns at this point, because we've been through significant volatility over a couple of years now, where if you saw that growth of between 2015 to 2019, I would say in the Permian, right now everybody is a little bit more careful, because you had one in a, I don't know, century pandemic, right? You have an OPEC um, kind of like a relationship environment that's a little bit more tricky now, where barrels do come back to market. So that spare capacity is coming back. You do have participants within OPEC that maybe not compliant with kind of what all entities agreed on. So this creates uncertainty, and markets hate uncertainty. Economics hate uncertainty. So, and the CEOs and management teams, they're not only in the business of making money, they're also in the business of keeping their jobs. You can't just I mean, you know, like look at those numbers, right? Like that's why there was this deal today, and the language was very clear. The language was very clear why this deal was done. If you look at net debt 2.1, long-term debt 1.9, so they introducing 450 million into the portfolio back into the balance sheet to reduce the debt. And now the net debt to FFO, it's 1.4, right? You got to be a little bit more disciplined, and so that's kind of what they're doing here. And the exact language they used is net proceeds from the transaction will be directed towards debt repayment to accelerate deleveraging efforts and strengthen Vermilion's balance sheet. Based on current strip commodity pricing and operational plans, we would expect to exit 2025 net debt 1.5 billion, trailing net debt FFO ratio 1.4 times. So the language is very clear. There's very little debate or dispute why they did what they did here. Nice hat. Yeah, thank you. That's right. That's right. Bosch, can you hear me okay? Can you hear me good? Once we're done talking about Vermilion, we're going to talk a little bit about MEG and Strathcona and just kind of see what's going on there. And as I said, I love this map. I mean, I could probably like look at those pieces of puzzle pieces like for hours, just trying to understand like who is where, what's possible. You would also notice like there are some pockets here where big companies like Canadian Natural and Tourmaline will have like different pockets, right? Like just totally not linked to the kind of overall asset. So you could wonder, well, would that be a core asset, or is this something that maybe future core asset where they will be kind of building around that? Is this something that's in the plans? And then if you zoom into the picture on the right, which we didn't talk much about, you do see Vermilion position, which relatively very concentrated position. Um, there's this company in purple color, always having a hard time saying the name, Colcanth. Maybe one of you can teach me in some point how to say it properly. Coelacanth. Yeah. Anyway, obviously we're seeing here higher gas partitioning in the gaseous phase, a little bit more towards BC on this map, as well as arc in that specific region, and then a little bit more kind of oleic towards the east side, right? Um, and then right next door to them we have Birchcliff producing a lot of gas, right? So that's kind of what's going up in that little envelope right there. But um, Tourmaline is definitely kind of integrating themselves into that region as well, and there is this kind of band kind of going more towards south there, south Alberta, kind of from north towards south. You can see on the right side. So we can just guess about future kind of opportunities and who is going to get what. But nevertheless, it's quite intriguing, I think. Okay, capital allocation. Yeah, there was like net debt to funds flow. I guess FFO stands for, what does it stand for? Operational funds flow. So they reduced that. They reduced it further today, right? Yeah, they showcase some percentage of production that's hedged, crude oil, European natural gas, right? And that's kind of I don't know. It's a positive and it's kind of a negative too that I've heard from some people say, right? Like they hedge in European gas, like so when TTF, I guess, gets torquey, you want to maybe take advantage of that, but then there are some hedges that are in place even for 2026. So I guess something to be mindful of. Annual dividend per share here. Good slide. Operating netbacks. Uh, so the question then, what's the Vermilion 2025 operating netback based on different countries, right? And so they're showcasing here Ireland, Netherlands, Croatia, Australia, Germany, France, and they tell us the different partitioning. So gas, 100% gas in Australia, Germany 69, gas 100% in France, and then the relative netbacks, right? So some in $80 per flowing, and some in France case it's just under 40. Anyway, lots of slides here to kind of focus on and understand asset overview. Maybe we'll focus on what's kind of valid more for the transaction that took place today. So in Canada, you can see right there we have Q1 production, so 69,721 BOEs per day, 38% liquids, and 104 BOE, 33% liquids in Canada there, right? But you can see on the right side, the southeast Saskatchewan, and then there's like a Wyoming site there where I don't see any production there. Maybe it's just like land that they have there. Um, Deep basin targeting light oil and condensate rich natural gas. So rich natural gas, condensate rich natural gas. It's really kind of higher oil cut, right? And in the Montney, you can see targeting liquid rich gas in Peace River, are straddling the AB-BC border, 80,000% net acres, Montney rights, my area in the Peace River. But we don't know. Maybe like they're kind of all over the world, right? So what's the future of that kind of little asset there? So, and like we said today, 10,500 barrels a day were divested from the Saskatchewan kind of Manitoba region, I guess. Okay, thank you, Vermilion. And that was my update about Vermilion. So, what I wanted to talk about next, let's see if there are any questions or anything people want to mention. I just saw like one comment so far. We have about 750 people watching this. The next thing I wanted to talk about, so I think Vermilion's pretty clear, a good plan, but the stock didn't kind of did neutral, I guess. It was down 1%, but I don't know, maybe investors see value in that. All right, so now I want to talk a little bit about why like what's kind of attractive in MEG, and there was a little bit of a discussion about twins between Strathcona and MEG, and so I want to kind of maybe share some of my thoughts based on publicly available slides, which companies were generous in providing for investors, I guess, in their website. So this is on the MEG Energy website in public domain. Same with Vermilion. Um, but I really wanted to talk about kind of like what there was this offer from Husky, right? Investment bankers talked about that, and the logic there was kind of like, well, if they rejected the offer back then, it doesn't make sense to do it now. And so let's talk a little bit about kind of what's going on here. So we're looking at about 100 to 600 based on this slide. Now, previous quarter production was about 104,000. Don't take my word for it. I'm not sure exactly where they at, but my understanding there's a turnaround. And when it comes to turnarounds, and maybe this is a good opportunity to show this chart. When it comes to turnarounds, you can see it's a fairly routine exercise. So here we have historic turnarounds. I will talk a little bit more about the dynamics of what it means, of what happens during turnarounds. But the production will be going down in Q2, so which is during that quarter. And maybe there will be a flush production that will compensate. So, but the companies are pretty good in talking about that. So I will try maybe talk a little bit more about turnaround, and then I'll get back to on topic to why MEG. I don't think MEG is a twin to Strathcona. So in my view, so what you see here is scheduled CPF turnaround. CPF stands for Central Process Facility. So all those assets, thermal assets, they're like big water management sites. So the huge amount of facilities, right? A lot of kind of infrastructure, pipes, different, steam generators, water handling tanks, lots of processing equipment. That's the bottom line. And everything there is in billions of dollars, basically, right? Because if you think about what we learned from the companies that currently develop assets, what we do know is that the greenfield development for an asset today is at least 30,000 per flowing. Well, this asset produces about 100,000 barrels a day. So 100,000 barrels a day times 30,000 per flowing, that's about $3 billion. So to advance this asset today, if you were to start from scratch, we're looking to that type of price, at least minimum. And once a year or every couple of years, there is a scheduled CPF turnaround, which means maintenance, scheduled maintenance. So then they basically shut in those the pieces of equipment and go over them to see if there is no corrosion, no issues, no potential scale like corrosion, right? Like all kind of issues. And best case, they say, okay, it's great, everything looks good. Worst case, but they would already know because everything is highly automated and well understood because there's lots of inspections and activities. They will say, okay, we need to fix a couple of things. And so they will do it during the turnaround. And as you can see, what actually happens in practice. So for example, we're looking at 2014 to 2020 timeframe. We had 1, 2, 3, 4, 5, 6, about 6 turnarounds, major ones. You can see the blue line goes down, the red line goes down. Those two are correlated. So the red line would be the steam injection rate, and the blue one will be the water production rate, which is basically the condensed steam plus connate water or water from the formation. So for example, you can have like a bottom water formation below the reservoir, and some of the water could be produced if, let's say, pressure drops. So you can see maybe some deviations between the blue and red line. But long story short, basically the injection facility is going down, maybe some gas injected to pressurize the reservoir, something like that. But you can see the impact also is on the oil rate, because in this business, like when we talked about Vermilion, for example, they would use fractures, like in the Montney, for example, to produce tight oil, like from tight oil formations. So they will produce light oil or light or gas, right? So the light ends from tight formation. So they will frac the formation, and from that formation, by pressure gradient, because it's very deep on the ground, the light oils will come to the fracture and be produced to surface. Well, this type of oil is like a hockey puck. It sits fairly shallow, so about 400 meters underground, but it's as hard as a hockey puck. It's basically sand saturated with oil and some water. So if you frack a hockey puck, nothing happens, right? You cannot produce the oil from the hockey puck. It's just not going to flow. So that recovery scheme is not applicable in the in situ oil sands business. And so what you see here, they inject steam, which is the red line, and that's really the fracs in a way to provide the recovery scheme. So you will inject the steam, there will be a heat transfer component, and then you will drain the oil by gravity towards the production well, and that's kind of the driving mechanism for the process. So what you see here basically is that steam goes down. Now the recovery scheme kind of driving mechanism is going down. The heat transfer is decays, therefore oil production rate declines. And so now we have a turnaround phase, right, that was communicated, and oil production will decline. But usually it's baked in the guidance for the company. So now we have scheduled CPF turnarounds, and that's kind of what you see on this chart. So let's go back, I guess. And another thing I would say here is that what you see on this chart, you can see your green line is cubes per day. So cubes per day, usually you will translate to barrels per day, and the multiplication there is about 6.3, 6.3, right? So you'll get about 100,000 barrels a day. So if you produce 16, 17, you get to about 100,000 barrels a day, which is kind of where we're at, right? Based on this slide right here. So 102, 104, 98, 99, and it kind of fluctuates, right? Kind of fluctuates. But you can see here that the production does not decline on the asset. So the steam is basically sustained and oil production sustained. So maybe I will use this chart kind of in support of my argument that I don't think the Strathcona, for example, assets and the MEG assets are made necessarily twins. Why is that? Well, we had an example I tweeted recently, is that they're expanding brownfield expansion right now, and so they're going to be producing extra 8,900 barrels a day. And the exact language I shared there, and you can go on my I guess wall and see the picture that kind of stole, well, not stole, but I guess used from MEG Communications on LinkedIn, that you can see the truck, oversized low truck, and it carries a steam gen. And so that steam gen, it's steam generator, and that steam generator produces the steam to be injected to the reservoir to produce the oil. Because remember, it's like a hockey puck. You need to melt the hockey puck or reduce the viscosity of the oil from the giant hockey puck, and the driving mechanism is the steam injection. And so what they say here is that basically this one piece of unit translates to about 8,900 barrels a day. And how do they know? Is based on the geology and the reservoirs, the steam to oil ratio, and you can see the steam to oil ratio in this chart, is about 2. So you can see the kind of the dotted line. That's the instantaneous oil steam to oil ratio. Now, I've seen people that write in Substack make a mistake saying, well, this is instantaneous, meaning it's well, no, the calculation here it's monthly. So those are monthly kind of steam to oil ratios. And the smoother steam to oil ratio, which is the aggregated steam to oil ratio from all the dotted lines, is that black line, which suggests that the SOR on the asset, the cumulative SOR, so CSOR on this chart, is about 2.2, which means that you need about 2.2 barrels of steam to produce 1 barrel of oil. That's kind of what it means. And if you look at this chart, it kind of makes sense. And so fundamentally, why am I arguing that this asset is kind of different than comparing a bunch of smaller assets? Is that based on this geology and based on this injection, that 8,900 barrels a day, which is Christina Lake production, it will kind of translates from basically that steam gen. But if you have a different asset, let's say with SOR 3.5, right? You have the same volume provided of steam that's being injected, but the reservoirs are different. The geology is different. So under that reservoir scenario, under that geological scenario, which we cannot dictate, I mean, it is what it is, right? You can have various kind of heterogeneous geologies, inclined hydrolytic stratus, non-permeable barriers, low conductivity zones. This translates to 5,500 barrels a day. So now we say, okay, well, if I buy, let's say, a piece of equipment for my house and it produces, let's say, 8 units of something, and if I buy the same thing, but it produces 5 pieces of something, or you can compare, let's say, horsepower on your car. Let's say you press on the pedal, it produces 8 horsepower, just as an example. But if you press in a different car, it's 5. You get 5, maybe 500 or 800, whatever you want to think in the way you want to think about that. Well, fundamentally, it's not the same, right? And why is it not the same? Because the unit, the steam gen that you bought is the same price. So the capex is the same for that unit, but the output is different based on different geologies. Because unlike engine, it's not you kind of customize the engine before in a sense because the geology you can't control. It is what it is. So so that's kind of, I guess, the challenge in comparing various assets, right? That's kind of the main challenge I think people should think about, and how that initial capital expenditure translates to the output essentially. So from technical point of view, from engineering point of view, I think comparing a 3 SOR asset with 2 SOR asset is a little bit kind of challenging, right? Because if you get 3 and here you get a 2, then it's fundamentally different. The other thing I would say is that, let's say you inject the steam, right? Which is in both cases you do with that steam gen. Well, then you produce a certain barrel of oil from that, right? But if you produce, let's say, less oil, then the energy intensity per barrel is higher for higher SORs. So I will say it again, like if you spend more energy, more enthalpy on something to produce something, but you produce less of it, but you injected the same amount of energy, or enthalpy, the unit there is joules per kilo, so energy per unit of mass, then by definition, you're higher energy intensity asset, you know? And so I think that that's kind of the way I think about this, is that if you look at different plans to reduce emissions, so guys like me would go and do this type of work, is that you need to consider steam to oil ratios. That they're important because fundamentally now you emit more, so you need to reduce more, so you probably need to spend more on reducing more, if it makes sense, right? And it's best from a capital expenditure perspective that you spend maybe the same, but the output is more by producing more oil. And by the way, this is in perpetuity, right? This is like for the rest of the life of the asset, because geology is the one thing we can control. It's just we can't control geology. Geology, it is what it is. So, and some geologies are maybe not economic to produce oil from, because if you have a pay that, for example, pay that may be very thin pay, if you put injector producer right away, you reach the top of the zone, and then you expand and your SOR is just going higher. So maybe it's not even economic on the type curve to produce that oil. And so I think about those things a little bit differently. The other perspective I want to share, I guess, on this topic is that the scale of things. So, for example, if you have, so this asset, right, produces that much oil, right? It's concentrated. There's many kind of, soon we're going to see basically on their, basically the lease on how much oil they have in place. So let's see that. So here's a slide that talks about project area. So original bitumen in place in their case is 4.1 billion barrels. Original bitumen in place. The development area where the company operates is about 2.8 billion, 2.28 billion. But the combined active wells is about 0.9 billion. So, which basically means that from the cumulative recovery scheme, the project area recovered only 9% of the oil based on this date, right, in June 2024. So now you kind of take 100,000 barrels a day, you add, and you get a little bit more. Maybe it's closer to 10 on project area. Maybe development area is about 17, 18%. But I guess like it's really important because now you're looking at this, you're like, wow, like this asset been operating what in this picture here since 2008, so it's been 17 years, and just on the wells where the operation takes place, it's been recovered only at 40% recovery factor. So there's another like 15 years or so, 16 years, I don't know, to produce kind of at the same rate only around that region. But then from a development area point of view, like if we look at kind of the broader asset of what could be developed, you get project area, you get 9% out of the 4 billion, right? And so if you think about kind of Canadian, I guess, reserves, you will have, I guess, 2P, it's about 160 billion. So that 4 will be out of the 160. And development area is about 2.28. So here, basically, you do quick calculation. You're like, man, I have like 30 years of producing that at this rate, like at 100,000 barrels a day. Now, as I shared, so which is the green line, yeah. But the company is saying, oh, okay, but we're going to brownfield expand, and we're going to spend about, I don't know, 20, 25,000 per flooring, something like that, to increase that capacity to produce more oil by adding steam gens, by debottlenecking, by adding more facilities at the back end. So we can, for the next 30 years, produce at 130, 125, 135,000 barrels a day continuously for the next 30, 40 years, whatever it is, right? And you saw based on the original bitumen in place kind of disclosure there is that it's very doable. Now, the other thing I would say is that the recovery scheme is really injecting steam, right, from the beginning, producing that steam back in the form of water because you get the heat transfer. So vapor pressure curve, you basically go on the left side of the vapor pressure curve. The water drains down with the oil that you produced. Now you separate the two, you take that water that you recovered, you recycle it, and you inject steam back. So it's a giant recycle process. So what you look in here at is a giant recycling facility of water, basically water generation, steam generation, and water recycling, where the oil goes to sales and the water is being recycled and redeployed. The blue line supports that messaging because that's the produced water rate. So you produce that water back and you treat it. Now, if your SOR is lower, which means like you inject less steam to produce 1 barrel of oil, by definition, it means that you handle less water at the back. Now, if you operate, let's say in Saskatchewan, you could have different regulations where maybe you don't recycle the water on the smaller assets. I don't necessarily know kind of legislatively what's going on there and how they just, if they just like dispose of that and like some aquifers, right, underground safely, which is, by the way, totally safe because the aquifers, they have the right TDS for the water to be disposed. It's total dissolved solids. So it meets a requirement of not being fresh water. So that's totally reasonable. It's not fresh water anyway, so you just dispose it safely on the ground. But here you recycle it, right? But let's say if all assets you were to recycle that water, let's say you like you have good sustainability kind of practices and you recycle that water and you reuse that water, you treat it, reuse it, inject. Well, by definition, if you have higher to steam to oil ratio, then you also have higher water to oil ratio because now the water produced to oil produced ratio is also higher because now that steam that you injected, you need to produce in the form of water, and you need to handle that water. So then that water in perpetuity, like it basically becomes that OPEX is also kind of becomes a little bit on the heavier end. So I guess like I'm not really suggesting um, the numbers are wrong or anything, or anybody like saying things that are not right or anything like that. But I'm just saying from a technical point of view, the way I understand those recovery schemes, steam to a ratio plays a very important role, not only from an economic perspective over length of time, right? But also from sustainability perspective. So when people talk about, let's say, uh, reducing emissions, well, lower SOR assets by definition reduce emissions because they operate at lower energy intensity to produce a barrel of oil, because that steam requirement is less. You don't need as much enthalpy to produce a barrel of oil. So I look at this a little bit differently, I guess, than others. And this map is kind of the MEG development map, where the different patterns, the different pads where they're located. And you can see around kind of the development area, they could drill other wells, other pads, or extend wells, and basically redeploy the steam to those wells and kind of keep going like this, right? So the steam is being recycled, reused, the water being reused and steam generated, and now you redeploy it and keep going. And that's how they maintain basically this chart for the past 18 years, right? So yeah, 17, 18 years. You can see like in 2014, there was a big event that took place. You can see the steam injection really increasing. The water production correlates with that. And that was phase B, phase 2B, which is the growth of the asset. Another big event happened around 2010 where they went basically from kind of the pilot stage, really injecting 10,000 cubes a day of steam, translating to at SOR2 that 5 to 5.5 thousand cubes per day. So you multiply by 6.9, it's about 35,000 barrels a day. In 2014, big investment, not huge investment. The investment they're making now is not as big because incrementally, I think it's about 25,000 barrels a day. But here you had a big jump going basically from 12, 13,000 cubes a day to like 33, right? That's like huge, right? Like three times jump in steam generation capabilities. And that's how, eventually they got to 100,000 barrels a day. So, which makes sense. By the way, guys, we have 1,000 people watching this live. You're basically watching a reservoir engineer talking about Canadian oil recovery schemes. That's what you're watching. And by the way, this is my disclosure here. Here, I'll remove myself. This is education, entertainment purposes only if you find this funny. But maybe it's not as funny. I don't think it's that funny. Okay, so we covered some of that. So let's go back kind of from a technical perspective. We covered a lot of kind of the SOR, the production, the water to oil ratio, the steam to oil ratio, what's currently happening when it comes to brownfield expansion. And we're trying to better understand kind of like from a value perspective what this value is, right? Because there is an offer on the table and there is this opportunity now to basically for somebody to own this asset, right? It seems like kind of that's where things are heading. And like I said, in 2017, there was an offer, or 2018 from ASCII, and it was rejected. But you can see from in their financial discipline slide, their net debt outstanding in US dollars, it was over $2 billion. It's in US dollars. And now it's about 600 million Canadian. So what is that, like 400 something or maybe 300 something? Anyway, you get the idea, right? And so, but since then, like what really changed from 2018? From 2018, the oil production rate was slightly less, but pretty much in line with the standard deviation of what we're talking about here. And so, if oil production didn't change, The asset, I guess the lease recovery factor is 10, 9%. So you have another like 30 years to go. What kind of what value do we assign to the debt going down from over 2 billion US to zero point 0.4, right? Billion, so 600 million Canadian, which by the way they didn't touch in they didn't pay off in the last quarter because the strategy right now is the 10-cent dividend they have. So they have this 10 cents per share dividend, which is quarterly, and basically buying back shares with the remaining free cash. So that they don't deploy for brownfield expansion. And obviously, we see a share reduction here from 300 million shares to what is that, like 265, something like that. And kind of that's where we're at. That's where we're at with this, right? So that's why there's a lot of debate. It's like, are these companies they're equal in nature or the same? People look at different economics, but then at the same time, you know, if you look, let's say, on the CPF perspective, oh, sorry, what am I doing? When you have those turnarounds and SOR, which is 2.2, and you have this kind of like value proposition that's kind of unique because, and people talk about this all the time, right? On news channels and such, saying, look, it's very simple to understand. Like this company is like literally one asset. They do one thing and they're specialist in this one thing. That's kind of what they do, you know? And if you buy in this company, you buy in Christina Lake asset with that production. And maybe the entity that buys will say, well, we don't want the expansion, but I'm sure they will because the economics look pretty good. And then, as I shared before, you get basically from the reserves point of view, and really the idea there is like how long can you go? You can see here from the combined active well patterns, you get 0.9 billion or so as of June 2024. At 40% cumulative recovery, development area 2.2, 2.3, some 16% only recovered so far. And from the overall project area is about 9% last year. So I guess by now it's like maybe 10%. So you get a 90%, another 90% of cumulative recovery forward looking. So that's the opportunities that they produce for 18 years, 17 years, and you have another 30, 40 years to keep going like this, which is kind of cool, right? I think it's pretty cool. And here also, like, they have a slide on development reservoir parameters. You have an average pay height of 24 meters, porosity 30 to 36%. You know, other assets could have that as well. Water saturation, pay water saturation range fraction between 18 to 40. My understanding is that closer to 20. So you'll have about 80% oil saturation. They're well known for their really excellent horizontal permeability. So those will be like permeability is really, you take this porosity, so it's kind of porous space. So when you heat the hockey puck, it's basically the ability of the oil to flow through porous media, right? So you have little spaces between the grains of the sand, so where the liquids can flow. And so porosity in darcies or millidarcies in the Permian, this is basically the ability of the fluid to flow through porous medium, right? And if you have like something like a 1 or a 0.5 Darcy for oil sand, it's pretty poor. But if you have permeability of 5, that's pretty good. If you have 3, it's a little bit challenging. Here they have vertical permeability of about 2.5, which is good because you drain by gravity anyway. So then the gravity is your driving mechanism. And initial reservoir pressure is about 2.1 MPa, so 2100 kPa. And native reservoir temperature is about 13 degrees Celsius. So, and usually on the vapor pressure curve, you'll inject that steam and that heat transfer will be generated. So you need to operate above, let's say, 200 degrees Celsius at times, because that steam is coming in very hot and it melts that hockey puck and produces the oil by gravity. And the hockey puck dimensions, it's not just like a hockey puck, like literally a hockey puck. It's a 24-meter pay, right? And maybe like 60 meters, 30 meter to each side, and it's about 1 kilometer long. And so I've seen some wells that, for example, some new wells at Hanging Stone, there, for example, I think it's 1,200 or 1,400 meters. So very long wells. And so those produce for years and years and years, right? And here they have the different pattern for reservoir parameters and bitumen in place and recovery factor estimates. And what that correlates to, you can see the pattern number on the left. So it says A, V, G, H, A, P, A, F, right? A, N, P, A, Q. And so you can go on the map and kind of geo-reference the table to those patterns. So you have pattern M, pattern N, pattern P, pattern DC, right? So they just have basically different names to those pads, to those kind of forky looking well pairs, right? And for each one of them, you can see what's the recovery factor for each one and where they're going to drill the next ones. And you can see kind of what's older, what's younger, what's the estimated ultimate recovery factor, so EUR. For Vermilion, when we looked at EURs, you can see also their production, right, in different EURs. So and recovery to date. So you can see like you get 20%, for example, for DE at the bottom of this table, 22% recovery factor. So there are many more years to go, right? Original bitumen in place, 4 million, 5 million, 1 million, 16 million for phase two there. You can see V is maybe 4 million. The area in meter squared, so area, right? Meter times meter, meter squared. And the net pay thickness is 24, 21, 23, 25. And that's the other challenge, I would say, is that when you look, let's say, at reserves for different assets, some could say, well, we have the same reserves. We have the same number of reserves. Look, we have, this is the pay we have, and we have the same reserves. But what happens, let's say, if you have especially in higher SOR assets, you have, for example, geologies that non-permeable in the middle section of the reservoirs. What happens then? Because if the steam is rising and it's more like low conductivity, low drainage areas, how do you kind of overcome that, and how do you go around those areas? It's very difficult. So yeah, sure, maybe you have a lot of reserves on top of the upper sections, but are you able to drain those? And that becomes the challenge. And guess what happens in those situations? In those situations, the SOR is increasing. So I guess, and that's how companies decide where to drill, where the best spots, right? And so somebody said in their comment a couple of days ago, they said, well, but the SOR is kind of increasing because as you expand the chambers, you have that SOR. Yeah, but that's applicable to everyone, right? Because once you have the steam is rising, once you get kind of lateral growth of the chambers, it requires more energy. And that's why companies like MEG, for example, they inject non-condensable gas, which is methane. By the way, there's a lot of also methane embedded in the bitumen that comes out of the hockey puck, out of the solution as well, and being reused kind of as a flue gas or reinjected. But long story short, lower SOR assets are unique in that sense because there are many advantages, like the water treatment, the least steam requirement, the cleaner geology aspect of things, the cleaner sand. Just not like worrying about like what the reservoir development may look like in the future, right? Like there's a little bit more comfort in cleaner reservoirs, right? And you can see average porosity like 33, 32. Oil saturations, I said it's around 80%. And so here they said it's 0.15 to 0.40. So they kind of didn't really want to tell us the water saturation. But because we know the table, right, we look at the oil saturation, see 70, 80. So you kind of like, hey, this is not like really 40 on the water side. It's more like 20, right? Because here you get 78, 79, 75, 81. And what this is really like within the hockey puck, within the porous medium, what is the saturation of those liquids that when you heat them come out of the solutions? What is the drainage composition looks like? The bitumen and the water, right? And so the partitioning is about 80-20, right? And that's kind of what we see from the table. And the different permeability ranges. And I love the fact that they have 6 Darcy permeabilities. This is really good. So obviously you can see there's lots of opportunities for that asset to be produced for many, many years. And I think that's why this asset is so attractive from investment point of view. I think that's why, there was lots of discussion about Strathcona. And by the way, I have so much respect to Adam Waters. I think he's a brilliant guy. I think he's just brilliant, right? I mean, in my mind, and I would love to interview him maybe on my YouTube channel or talk to him about his thoughts. But and if Adam, if you see this is amazing. But in my mind, he's like he sees opportunities in those thermal assets, right? I mean, clearly he was able to monetize. Well, I'm talking about him, but I'm talking about Strathcona and the Water Energy Fund. I guess I should be talking about those entities more. But they were able to monetize the Matni assets and kind of the vertically integrated assets in a sense, and the Grand Prairie asset, and kind of collaborate with Tourmaline and ARC and the third party as they divested those assets. But now the focus shifting towards pure thermal recovery, low decline, low cost of supply assets, which I love and respect. I think it's great. People maybe misunderstand me how I think about this, but I think it's like, if I was them, I would do probably the same. Uh, at the same time, the challenge I have personally is like, okay, well, uh, look at this chart, right? I mean, look, it's so predictable, so beautiful, low cost of supply, low SOR. This company kind of did this thing, right? When it comes to lowering debt, production sustained, share reduction achieved, debt target achieved, value being kind of created. And I know it's not perfect. Nobody's perfect, right? We're not gonna like solve this argument here, but I think there is value to certain assets, right? There's value, and it's going to be intriguing to see how it's going to unfold. That's kind of my view, right? How is this going to unfold? One thing for sure is that this wonderful asset is going to continue producing oil at over 100,000 barrels a day for the next 20, 30 years, right? Till I'm very, very old person. And those steam gens that generate the steam are amazing, and they're going to continue operating. And those turnarounds, which is why production is likely to decline in Q2, you can see in this chart, the maintenance activity is going to continue. Now, the other really cool aspect of this asset is that you have the yellow line, which is the gas injection rate. So you can see for the past 10 years, the company been co-injecting methane to pressurized reservoir, which also yields basically reduced energy intensity and better utilization of steam, because now the steam is being reallocated to fresher wells to drain oil by gravity, right? So, and then that gas is being produced and recycled to be reinjected again. That's how we maintain the bottom hole pressure in those reservoirs. So basically, that's kind of what happens here. And you can see the steam profile, yes, it's increasing, but the oil rate is also increasing. And the legacy wells, to maintain production, like the trickling production from those wells, are being pressurized by non-condensable gases, which is a wonderful technology. I highly recommend Googling non-condensable gas co-injection. This is something that one of those unique technology development aspects in our industry we're very proud of. But some people think, okay, well, oil industry, what are they doing innovative? What's innovative here? Well, I think it's really innovating. Like, think about this: you inject something like 400 meters underground. You can't really see what's there, but at the same time, you monitor bottom hole pressure. You're operating all the liquids. You have full understanding of what comes in, comes out. You did reservoir modeling simulations where you visualized everything before you even injected anything or produced anything. You know exactly what the material and energy balance is going to look like before you even touched or drill a well. And that kind of understanding of the economics of the different cycles, you don't necessarily integrate things you don't have control of, like OPEC policy, but you do have like understanding of future demand and growth, and Asian demand, and the fact that those are heavy molecules that are barely produced in the United States. The fact that you have a pipeline, going to PADD 2 to Chicago area, 3 million barrels a day, obviously diluted with condensate, being shipped there, that you don't really have access. Like, you can't really access from New Jersey, or you gonna have to reverse flow in the pipes if you're going from Texas. At 3 million barrels a day, it's not feasible, especially today, where a company is telling you, hey, we're kind of maybe plateauing here at this price, and maybe if we go to 50, maybe we're not even sustaining production at those levels. you don't have that incremental production increase. And so what you see here is basically opportunity to provide stable, safe, reliable, heavy molecule energy. And then people would say, well, we don't need that Canadian oil. What? Okay, well, what about like, or we're going towards batteries. We're going towards batteries, EVs. Yeah, but you still have asphalt. Like you still have shingles. It's kind of mind-boggling to me. Like the tires don't know that what they're driving EV, or the tires. There's no technology that replaces the tires. Like there's no technology. Like there's no battery you put on a airplane and you fly to overseas on that battery that you attach to the airplane. The jet fuel is still in the jet, powering the jet to fly, and heavier molecular there, like kerosene is there, like I don't know, jet fuel, C10 plus at least being mixed with light oils. I mean, gasoline is from light oils that America could be relying on, but the heavier molecules, I mean, where is that coming from, right? And obviously, huge demand in Asia and those type of countries. And then the other type of similar type of oil you will have in, let's say, in the Americas, you will have in Venezuela, right? And so that's a not entirely different conversation. I guess it will depend on Trump's kind of energy policy when it comes to like, or diplomatic policy when it comes to Venezuela, like how to approach them. And we do know the production there was not like at that scale, like Canadian production. So obviously, I have a bias, but I think it's well understood why there is value to those large mega assets that don't really mega. See what I did there? Mega assets that don't really exist, right? Because you have the bigger corporations and they don't really sell those assets. They see them as core assets, right? The Canadian Naturals, the Suncors of the world. You don't see Fireback being sold. You don't see Jackfish for sale. I mean, Devon divested Jackfish, so CNRL bought it, but they didn't buy it to sell it, I don't think. I mean, of course, there would be a price for it, but who is the buyer at higher prices now that, I mean, but it's hypothetical. CNRL is not even selling, so it doesn't matter. So, well, anyway, I just talked to myself here. I see we have 1,200 people listening to this, so I'm very honored. Thank you. Thank you for listening to me. I guess this was kind of overview of MEG Energy acquisition, the value proposition of this company, why it wants to get acquired. Um, you know, uh, I guess we talked a little bit about. Oh, I'll minimize myself. We talked a little bit about the production there. We talked about the Vermilion deal earlier today. So that was the Vermilion deal. So we covered that. So they divested of those assets here, Southeast Saskatchewan, 10,500 barrels a day. And we talked about the fact that it shouldn't. Oh, can I just go? Oh, yeah, wonderful. I can just go straight to the first slide, and we can see in the numbers that it's super rational why they did this. And I know there was conversation that when they bought those assets, they paid a lot, but I think it was over $1 billion, to be honest. But I'm not sure exactly. Like I didn't do enough due diligence to give exact number. But I would want to believe that the cash flow during that time frame and gain some value. And now that you look at the market cap, enterprise value, net debt, long-term debt, and net debt to FFO ratio going from 1.7 to 1.4, long-term debt going from 1.9 to 1.5, that makes more sense to me from kind of balance sheet perspective, that it's a logical move for Vermilion Energy. Okay, my friends. Well, let's see if we have any comments, any feedback. Anybody wants to ask anything or share anything? We covered Vermilion and kind of MEG, I guess, value proposition today. Mainly talk to myself. Oh, okay. So somebody said here, IBB said, VET owns 20% of Colicant. Colicant? Is that how you say it, guys? Colicant? And only a matter of time before they buy them out. Martin next door. Thank you, IBB. I think like we saw that in. I don't know if you were here when we looked into this, and we looked into this, and it says right there. So you're right. It says they own 22% of CEI dot V, right? Colicant, Colicant. Anyway, um, and yeah, you're right. So they are neighboring. They are kind of adjacent to each other. So the purple and the yellow sites, so they own 22%. So there is a synergy there. What's really intriguing about all that is, and I talked about that already, is the tourmaline kind of, they're like kind of have pockets, different pockets in that region there, at kind of central, I guess, Alberta BC border there. So they're also kind of hovering. We have Arc Resources in that region as well. Storm Energy, I guess it's a private company, and Birchcliff kind of to the more south there. A very gassy company. Lots of gas being produced in Birchcliff. Birchcliff, I have to share, it's one of those companies. So I've been following the production rates. They're like super predictable. Like they're kind of doing a good job, I think. I mean, I never actually thought about Birchcliff much, but now that I'm kind of more focused, like, about like covering maybe more names, kind of like, hey, you guys doing a good job. So very predictable production flow rates. So, but I'm sure some of you kind of already know that. I mean, go on Vermilion site and take a look at this map. I mean, I find it fascinating. And let me know in the comments or in the future if you want to share, like, what do you think kind of could be the next move? Because there's all kind of, it's like a puzzle, right? There are all kind of interesting dynamics that could be taking place, especially with LNG Canada coming online. Some say maybe in a few weeks, right? The 2 BCF or close to 2 BCF. The phase two, the kind of the commitment to capital, I guess, or FIDing the project is kind of unknown at this point, or maybe it's known to some, but not to me. But let's see what happens here with LNG. By the way, one thing I have to talk about, I find sometimes people use LNG, they just say LNG, right? But what is LNG? So just like when you go to Costco and you buy propane, right? The propane in the tank is oil. It doesn't know to be gaseous. Like, it's the vapor pressure conditions for that tank, for that propane, are making it to be in liquid phase. It's just, as humans, we use words like gas, liquid, right? But when we describe, let's say, condensed propane, we could say liquefied propane, right? So when we say LNG, it's liquefied natural gas. Liquefied natural gas is liquefied methane and ethane. But because in the vapor pressure curve, it needs very unique pressure temperature specs. For example, when you transport LNG, liquefied natural gas, in those ships, like, you have to drop the pressure. Pressure, it's reasonable, but you need to drop the temperature to like minus 160 degrees Celsius, minus 163, and you cool that and you liquefy it. So essentially, that LNG is kind of the oil version of natural gas, liquefied natural gas, which also means liquefied methane ethane mixture with higher percent of methane. So natural gas is, I think it's about 90% methane, 10% ethane, something like that. Maybe a little bit more, like 95, something like that. So that's kind of the idea. LNG, liquefied natural gas. So when people say LNG, it's really like a fancy way of saying I produce gas here and I transport that by liquefying that thing. And then at the back end, when you use it as gas. And because we can't really transport gassy things, you will need like giant balloons, infinite balloons in size, to carry that gas overseas. So the economic way of transporting that gas is by liquefying it. So that's really the invention here. Okay, my friends. Well, education and entertainment purposes only. Hopefully, you found this useful, maybe entertaining. I don't know. But yeah, thanks so much. Let's see if you guys have any comments, any suggestions, anything you want to share, and because I have a couple of minutes here, so no problem. You can stay a little bit longer and let me know your thoughts on the MEG, on Vermilion. Is it a good deal? Is it not a good deal? By the way, I saw some language today about other entities perhaps making a bid on MEG, and there was an article shared by Bloomberg that says Cenovus Energy top executive downplayed the chance the oil sands producer would offer to buy MEG Energy Corp, saying he is more focused on expanding existing assets than making acquisitions. And we're looking at this map right now, but I would argue like the relationship between, let's say, in different size, different scale, obviously, but let's say the relationship between Christina Lake Cenovus and Christina